Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 7, Unit 1, that is Final Accounts of Non-Manufacturing Entities. This is Lecture 1, Chapter 6, Preparation of Final Accounts of Sole Proprietors, and we'll begin with Unit 1, Final Accounts of Non-Manufacturing Entities. So let us begin. Let us see the learning objectives. After studying this unit, you will be able to draw final accounts of non-manufacturing entities, sole traders, learn the relationship between profit and loss account and balance sheet. So the profit and loss account is also known as income statement, and balance sheet is also known as statement of financial position. Statement of financial position. Statement of financial position, and it is also known as position statement. Understand the trading account items. This will help you to learn which of the transactions and events should be shown in the trading account. Next, understand the items shown in the profit and loss account. By that, you will learn the technique of preparing profit and loss account and deriving the profit and loss balance. Learn how to adjust outstanding and prepaid expenses. Outstanding expenses and prepaid expenses. Accrued incomes and income received in advance. Understand the items to be shown in the balance sheet, that is assets and liabilities. Also learn the classification of assets and classification of liabilities, and the order by which they put in the balance sheet, the order. So this was the learning objectives of this chapter. Unit overview. Non-manufacturing business entities. We'll learn about final accounts, that is trading account, profit and loss account, and balance sheet. I told you balance sheet is also known as statement of financial position. Statement of financial position, it is also known as position statement. Position statement, and profit and loss account is known as income statement. Let us move ahead. Introduction. Non-manufacturing entities are the trading entities which is engaged in the purchase and sale of goods for profit without changing the form of the goods. This means what? They are non-manufacturing entities. They do not buy raw material, do not convert into a finished goods and sell further. They just purchase this finished goods and they sell it further. In other words, non-manufacturing entities do not process the goods purchased and sell them in the original form. Meanwhile, it indulges in some liabilities, makes some assets, and also incurs some expenses like salaries, stationery, expenses, advertisement, rent, etc. to run the business. At the end of the accounting year, the entity must be interested in knowing the results of the business. To ascertain the final outcome of the business, the income and financial position, they prepare financial statements at the end of the year. Financial statement. Income statement consists of trading account and profit and loss account. The result of the trading account is gross profit. The result of profit and loss account is net profit. Position statement, we have balance sheet, that is positions of assets and liabilities. Financial statements are the systematically organized summary of all ledger accounts heads presented in such a manner that it gives detailed information about the financial position and the performance of the enterprise. As seen above, through categorization of financial statement into income and position statement, the profit is measured at two levels. Gross profit is calculated using preparation of trading account. Net profit is calculated using preparation of profit and loss account. Gross profit is calculated in trading account and net profit is calculated in profit and loss account. Profit and loss account. The profit of the enterprise is obtained through the preparation of income statement, that is trading account and profit and loss account. The financial position of the business enterprise is judged by measuring the assets and liabilities and capital of the enterprise, and the same is communicated to the users of financial statements. Financial position of the enterprise can be known through the preparation of position statement, that is balance sheet. Comparison between income statement and position statement. Profit and loss is disclosed in the income statement prepared at the close of the financial year. Income statement is subdivided into following two parts for non-manufacturing concern. Trading account, profit and loss account. Income statement discloses net profit of the business after adjusting from the income earned during the year all the expenditures of the business incurred in that year. Position statement, it exhibits assets and liabilities of the business as at the close of the financial year. Balance sheet. Apart from balance sheet to judge financial position of the business, sometimes additional statements are also prepared like cash flow statement. As per accounting standard 3, cash flow statement is prepared, value added statement, etc., which is mandatory for non-corporate entities. In India, very few companies make value added statements. It is an optional statement, so generally Tata Group prepares value added statement. Tata Group of companies, which is not mandatory for non-corporate entities. These additional statements are prepared for better understanding of the financial position of the business. Position statement discloses the assets and liabilities position as on a particular date. Next, preparation of final accounts. The principal function of final account, that is trading account, profit and loss account, and the balance sheet, is to exhibit truly and fairly and profitability and the financial position of the business to which they relate. In order that these may be properly drawn up, it is essential that a proper record of transaction entered into by the business during a particular accounting period which should be maintained. The basic principle in regard to accumulation of accounting period data are a distinction should be made between capital and revenue receipts and payments. Also, income and expenses relating to period of account should be separated from those of another period. Different items of income and expenditure should be accumulated under significant heads so as to disclose the sources from which capital has been procured and nature of liabilities which are outstanding for payment. Having regard to these basic principles, the various matters to which the attention should be paid for determining the different aspects of transaction, a record of which should be kept, and the different heads of accounts under which various items of income and expenditure should be accumulated are stated below. A. Distinction between personal and business income. Since the final statement of account are intended to show the profitability of the business and not that of the proprietor, it is essential that all personal income and expenditure should be separated from business income and expenditure. So personal expenses should be bifurcated separately and that should not form part of the business expenses. Personal expenses are categorized as drawings made from the business. Next, distinction between capital and revenue expenditure. A distinction should be made between capital and revenue, both receipts and expenditure. Different type of income and expenditure should be classified under separate heads. Assets should be included in the balance sheet by following accounting principle and accounting standards. Likewise, a provision of income and expenses which have accrued but not paid should be made by estimation or otherwise on the same basis as in the previous year. Third, all material information to be disclosed. Every information considered material for judging the profitability of the business or its financial position should be disclosed. Example, when the labor charges have been increased or on account of bonus having been paid to workmen, the amount of bonus paid should be disclosed. Similarly, if some of the items of inventory are not readily sellable, these should be valued at their approximate net realizable value on the basis of valuation, and the value of such inventory should be shown separately. Record any current period transactions. Though the record of transaction should be maintained continuously at the end of each accounting period, the transaction of the closing accounting period should be cut off from these succeeding period. Next, only transactions completed before close of account should be given effect. It should be seen that only the effect of transaction should be concluded before the close of period of account has been adjusted in the accounts of the year. For example, when a sale of the goods is taken place only after the goods have been inspected by the purchaser and the inspection had not been made before the close of the year, it would be incorrect to treat the goods as sale in the accounts of the year. Interrelationship of two statements. One of the points to be remembered is that total expenditure incurred, some type of expenditure appears in the profit and loss account and some in the balance sheet. Here are the few examples. First, salaries paid is shown in the debit side of the profit and loss account because salaries paid is an expense and it is a nominal account. So debit all expenses and losses rule apply over here. So it would be debited in the profit and loss account. But outstanding salary is a liability. So it should be shown in the balance sheet. Shown in the liability side of the balance sheet and added to the salary because it is still outstanding. So it would be added to the salaries in the profit and loss account. See the treatment over here in the profit and loss account, salary 25,000, salaries paid 25,000, salaries outstanding. It should be paid, but it is not paid yet. Outstanding should to be added because this expenses relates to this year, whether we have paid it or not paid it. It's that should not taken into consideration, but this expenses outstanding salary is of this year only, so this 1500 will be a part of income statement and added to the salary. Outer column 26,500. Now this 1500 is a liability which needs to be paid, so in the balance sheet outstanding salary will be shown in the liability side. I believe you understood. Next adjustment, when a machine is purchased, that part of which is attributable to 1 year to the year considered as depreciation is debited to the profit and loss account and the balance is shown in the balance sheet as an asset. Try to understand. The value of the asset is 5 lakh. The rate of depreciation is 10%. Fixed assets 5 lakh. Depreciation at the rate 10%. 5 lakh multiplied by 10% equal to 50,000. This is depreciation. This is shown in profit and loss account debit side as an expense, is a non-cash expense, and because there is a reduction in the value of asset in the balance sheet, 5 lakh minus 50,000, the closing value 4 lakh 50,000 would be shown in the balance sheet, and in profit and loss account this is an expense, but it is a non-cash expense, but it is an expense. Nominal account shown in the debit side, debit column. I believe you understood. These illustrations show that two statements of profit and loss account and balance sheet are thoroughly interrelated. The assets shown in the balance sheet are mostly only the remainder of the expenditure incurred after a suitable amount has been charged to the profit and loss account or the trading account. For preparing two statements properly, it is of the greatest importance that the amounts to be charged to the profit and loss account should be properly determined, as therefore both statement will show the incorrect position. The principle that governs this is called matching principle. I believe you understood. Next is matching principle. The principle demands that expenses incurred to earn the revenue should be properly matched. This means the following. A. If a certain revenue and income is entered in a trading profit and loss account, all the expenses relating to it, whether or not payment has been actually made, should be debited to trading and profit and loss account. This is why at the end of the year an entry is passed to bring into account the outstanding expenses. That is also the reason why the opening inventory of goods is debited to the trading account, since the relevant sale is credited to the same account. Next, if some expenses have been incurred but against it sale will take place in the next year or income will be received next year, the expense should not be debited in the current year profit and loss account, but should be carried forward as an asset and shown in the balance sheet. It will be debited to the profit and loss account only when the relevant income have been credited. The same reason is applicable to depreciation of assets also. The part of the cost which is used to earn current year revenue is debited in the same year, and so on. Next, if an income or revenue is received in the current year but the work against it has to be done at the cost in respect of it has been incurred next year, that is income received in advance, and income or the revenue is considered to be the next year, it should be shown in the balance sheet or the liability side as income received in advance and should be credited to the profit and loss account of the next year. Example, newspaper or magazine usually receives subscriptions in advance for a year. The part of subscription that covers copies to be supplied in the next year is treated as income received in advance. Next, exception. There appears to be one exception of the rule that only such costs have yielded or is expected to yield revenue should be debited to the profit and loss account. For example, if a fire has occurred and has damaged the firm's property, or loss must be debited to profit and loss account to the extent it is not covered by insurance. A loss resulting from fall of selling price below the cost or from some debts turning bad debt, must similarly be debited to profit and loss account. If this is not done, in the profit will be overstated and inflated. Note, the relevant entries and adjustment regarding the three items disclosed earlier later in this unit. Trading account. At the end of the year, as has been seen above, it is necessary to ascertain the net profit or the net loss. For this purpose, it is first necessary to know the gross profit of the business or gross loss. Gross profit is the difference between the selling price and cost of goods sold. Selling price less cost of goods sold equals gross profit. For a trading firm, the cost of goods sold can be ascertained by adjusting cost of goods still on hand at the end of the year, that is closing stock. It is done as follows: opening stock, add purchases, less purchase return, that is net purchases. Net purchases means purchase less purchase return. Add direct expenses less cost of goods sold equals closing stock. I believe you understood. Suppose in the first year, the net purchases, that is after deducting purchase return, is totaled 1 lakh rupee and 15,000 worth of goods at cost were not sold. That is, it is closing stock at the end of the year. The cost of goods sold will then be 85,000, that is 1 lakh minus 15,000, that is the closing stock, equals COGS 85,000. If in the next year purchases are 1,50,000 and cost of goods sold is 1,45,000, the closing stock will be 20,000 as calculated. 15,000 the closing stock relates to last year and 5,000 the new one. Cost of unsold goods at the beginning of the year 15,000 plus purchases 1,50,000 less cost of goods sold during the year 1,45,000. So closing stock consists of 20,000. Gross profit is usually ascertained by preparing trading account. The format of the trading account can be shown as follows: trading account, on the debit side opening stock, purchases less purchase return, return outward, plus direct expenses like carriage and freight, custom and insurance, wages, gas, fuel, factory expenses, royalty on production. Then sales on the credit side, less sales return, net sales, closing stock, and by gross loss carried down. If the balancing figure is on the credit side, it would be gross loss. If it would be the debit side, it would be the gross profit. Either there would be gross profit or gross loss. Only one will appear. If in the above example the net sales, that is after adjustment for sales return, is 2 lakh, then the gross profit will be 55,000, that is 2 lakh minus 1 lakh 45,000. The profit is called gross profit since from it indirect expenses have still to be deducted for knowing the net profit. Now for the same example, trading account will appear as follows: trading account for the year ended. On the credit side, sales, closing inventory. On the debit side, opening inventory, purchases, and gross profit, that is 55,000. Points to be remembered: the opening inventory and purchases are written on the debit side. Sales and closing inventory are entered in the credit side. If there are any direct expenses, then they should be also written on the debit side of the trading account. If the balance is on the credit side, The balance of credit side is more. The difference will be written on the debit side as gross profit. This amount will also be carried forward on the profit and loss account on credit side. In case of gross loss, when the debit side of the trading account exceeds the credit side, the amount will be written on the credit side of the trading account and transferred to debit side of the profit and loss account. Trading account items. In a trading firm like a wholesaler, the main business consists of In a trading firm like a wholesaler, the main business consists of buying and selling of same goods. In addition to the amount of opening inventory, the trading account will also be debited with all the expenses incurred in bringing the goods to the godown of the firm and in making them ready for sale. For example, freight paid on purchases, cartage, octroi, etc. will also be debited on the trading account. The rule is that this account will be debited with all the expenses incurred in bringing the goods at their present location or condition. We shall now consider individual items. First, opening inventory. Since this was closing inventory of the last year, it must have been entered in the opening inventory account through the opening inventory. Therefore, it will be found in the trial balance. This item is usually put as the first item of the debit side of the trading account. Of course, is the first year of the business, there will be no opening inventory. So trading account to opening inventory. Next is purchases and purchase return. The purchases account will have debit balance showing the gross amount of the purchase made of the materials. The purchase return account will have credit balance showing the return materials to the supplier. On the debit side of the trading account, the net amount is shown as indicated. Purchases less purchase return. So this is basically debit side of trading account. Closing entry for this purpose is as follows. Purchase return account debited to purchase account. This net purchases is transferred to trading account, that is trading account debited to purchase account. It happens sometimes that goods are received but the relevant invoice is not received from the supplier. On the date of the closing of the account, an entry must be passed to debit the purchases account and credit the supplier with the cost of goods. Carriage on freight inward or freight. This item should also be debited to trading account as it is incurred to bring the materials to the firm's godown and make them available for use. However, if the freight or cartage is paid on any asset like machinery, it should be added to the cost of goods, cost of the assets, and not debited to the trading account. Trading account to carriage or freight inwards. Next is wages. Wages paid to worker in godown stores should be debited to trading account. If any amount is outstanding, it must be brought into books so that full wages for the period concerned are charged to trading account. However, if wages are paid for installation of a fixed asset, it should be added to cost of the assets. So trading account to wages account. Next, sales and sales return account. The sales account will have the credit balance indicating the total sales made during the year. The sales return account will have the debit balance. So the sales return should be deducted from the sales account, showing the total amount of goods returned by the customer. The net of the two account is entered on the credit side of the trading account. Sales account debited to sales return account to trading account. Sometimes goods are sold on approval basis, that is when the customer has the right to return the goods within a stipulated period of time. In that case, the sale entry should be reversed. It is discussed later in detail. Next, closing entry and its valuation. Usually, there is no account to show the value of goods lying in the godown at the end of the year. However, to correctly ascertain the good gross profit, the closing inventories must be properly taken and valued. The entry is closing inventory account to trading account. Alternatively, closing inventory can be adjusted with purchases also. Closing inventory account to purchase account. The effect of this entry is to reduce the debit of purchase account. The closing inventory is also shown in the balance sheet asset side as closing stock. If closing stock appears in the trial balance, the closing inventory is then not entered in the trading account. It is shown only in the balance sheet. This is because it has already been adjusted in arriving at COGS, cost of goods sold. To ascertain value of the closing inventory, it is necessary to make a complete inventory or a list of all the items in the godown together with quantities. Of course, damaged or obsolete items are separately listed. To the list of finished goods, one should also be add the goods lying with the agent sent on consignment basis. Also, the goods sent on approval to the customer. That should also form part of closing inventory. The valuation principle is cost or NRV, net realizable value, whichever is lower according to accounting standard 2 valuation of inventories. Taking inventory is quite a lengthy process. Strictly immediately at the end of the year, the taking of inventory should be completed. Sometimes, however, this is done either a few weeks before or a few weeks after the closing. In such a case, the value of inventory thus taken must be adjusted to relate it to the closing date. The adjustment will be necessary because in the meantime, purchases and sales must have been made. The main point to remember is that in respect of sales, their cost has been established. Cost will be sales less gross profit. Illustration 1. A trial balance is given over here. Trial balance for the financial year ended 31st March 2017 of Messrs. Deep, Deep Dipakshi shows the following details. Particulars, debit information, credit details, purchase and sale. So this debit is purchase and credit is sales. Debtor and creditor, opening stock, closing stock, the other expenses and income, fixed assets and long-term liabilities, and capital. Additional information, creditor balance as on 1st April 2016 is given over here. You are required to calculate cost of goods sold and amount paid to creditor during the year. Let us continue. Solution. First of all, we'll calculate the cost of goods sold. Cost of goods sold. Opening stock. 2 lakhs over here it is given. Plus purchases. 10 lakhs. See, closing stock is a part of trial balance. That means this closing stock is already adjusted. So we'll not deduct closing stock from here. So 12 lakhs. This is cost of goods sold. Cost of goods sold, COGS. Next is calculation of amount paid to creditors particulars amount creditor, the closing balance is 4 lakh over here, and opening balance of creditor is 3 lakh is given in the adjustment. So opening balance of creditor by balance brought down 3 lakhs to balance carried down, closing balance 4 lakhs during the year purchases made. We have calculated purchases 10 lakhs. It has been given in the question 10 lakhs purchases. And this closing stock of 3 lakhs, this is also a part of purchases during the year. So 3 lakhs, 13 lakhs. Close it quickly. 16 minus 4 is 12 lakhs to bank account. Payment made to creditors to bank account 12 lakhs. I believe you understood. Let us move ahead. Closing entries in respect of trading account. The following entries is required. First, for opening inventory, debit trading account and credit inventory account. For purchase return, debit return outward account and credit purchase account. For return inwards, debit sale account and credit return inwards account. In the trading account, information is usually given in respect of both gross sales, purchases and respective returns. Third, for purchases account, debit trading account and credit purchases account, the amount being the net amount after returns. For expenses to be debit trading account and credit expenses account, example direct expenses wages, debit trading account and credit the concerned expenses account. For sales, debit sales account and credit with the net amounts after returns and credit trading account. Next, for closing inventory, debit closing inventory account and credit trading account. The inventory account will be carried forward next year. I believe it is quite simple. Let us move ahead. Except entries mentioned in 2 above, the other entries are usually summarized as follows. Trading account debit to opening inventory, to purchases, to wages, to freight and purchases return. For sales, the entries would be sales account debit, closing inventory account debit to trading account. At this stage, trading account will reveal the gross profit and credit side is more than gross loss if the credit side is less. The gross profit will be transferred to profit and loss account by the entry trading account to profit and loss account. The entry for gross loss, if there be any, is profit and loss account to trading account. Next question, question 2. Opening inventory is given, purchases is given, carriage inward is given, wages is given, sales is given, return inward. Return inward is sales return. It is sales return. Return outward, it is purchase return and closing inventory. From the above information, prepare a trading account of Messrs ABC for the year ended 31st March 2017 and pass necessary closing inventory in the journal proper of Messrs ABC Traders. Solution. We need to prepare trading account for the year ended 31st March 2016. Particulars, rupees, particulars amount. First of all, we'll write opening inventory and purchases. So 2 opening inventory, 1 lakh, 2 purchases, 6,72,000, carriage inward 30,000. It's a direct expense, it will come over here. To carriage inward 30,000. Next, wages 50,000, sales 11 lakh. Wages 50,000, sales 11 lakh. By sales return inward, sales return is 1 lakh less sales return, 11 lakh minus 1 lakh is 10 lakhs. Return outward, purchase return is 72,000 less purchase return, 72,000. So it is 6 lakh over here. Closing inventory is 2 lakhs. We'll write closing inventory over here. By closing inventory 2 lakhs. Let us do the totals. 10 lakhs plus 2 lakhs is 12 lakhs. 12 lakhs on the debit side. Less all these 1 lakh, 6 lakh and 80,000. The balancing figure is 4 lakh 20,000. It is to gross profit. It is to gross profit. Now we need to pass journal entries, the closing journal entries. Journal proper in the books of ABC traders. Date, particulars, ledger folio, amount, debit, amount, credit. March 31st, 2016. For return outward will pass entry. First is purchase return over here. So purchase return to purchases. First entry. Purchase return to purchases 72,000. Then for sales return will pass entry. Sales account debit to sales return 1 lakh. Next, entry for sales will pass for sales. Sales account debited to trading account. Sales account debited to trading account 10 lakhs. Then for debit entries will pass trading account debit to opening inventory, to purchases, to carriage inward and to wages. Trading account to opening inventory, to purchases account, to wages, to carriage inward. Opening inventory 1 lakh, purchases 6 lakh, wages 50,000, carriage inward 30,000, total 7 lakh 80,000. For closing inventory account debit to trading account 2 lakhs, and at last trading account debit to gross profit, to gross profit 4 lakh 20,000. I believe you understood. Let us continue. We are keeping this class till here only. We are keeping this class till here only. Thank you. Thank you.